Hey friends, Robert Band here. I want to share my guest's insight with you on bank financing. This is critical to all businesses, and we have the privilege of a South Florida banking icon with us today, Ramiro Ortiz. Been in South Florida banking for 50 years, and he's going to help answer questions that I'm going to ask of him that's going to show you how the banking side of the curtain works and how they take our information and our loan packages and what impresses them and what doesn't. So this should be great insight for all of my friends out there to learn about how a banker looks at a prospective bank loan. Ramiro, would you please introduce yourself in about a minute or so? Tell us, your background in banking and a little bit about your current firm and what you're doing. Thanks.
Thanks, Robert. It's a pleasure to be here with your audience, and I appreciate the kind words, especially the banking icon part of it. I would remind you to please tell my wife that when you see her. My banking career, all in South Florida, I spent most of it at SunTrust Bank, 22 years. I was fortunate enough to be president of that bank for the last 10 of those 22, and then 10 years at Bank United, and those 10 years as president of the bank. I retired from banking, and I've done a real lousy job at staying retired. And I've done a couple of things, but mostly I'm involved in a consulting capacity. I'm a senior advisor with the McCombie Group. I'm very excited about the things that we're doing. The full service consulting group, by full service I mean that not only do we do the normal traditional business planning, but if the business plan calls for a merger or an acquisition type of tactic, we go ahead and help execute that. On the other hand, if the business plan calls for a semi-exit, an exit, or a full exit, we facilitate that as well. David McCombie, our founder, likes to describe us in the following way, which I think is pretty descriptive. If Goldman Sachs and McKinsey had a baby, that would be us.
Okay, great. So let's go to banking, because I wanted to ask these questions and understand the behind the curtain scene at a bank. And so let's start with this. What, in your opinion, is the biggest mistake businesses make with their finances? Not their loan package, but just their finances in general.
Couple of things. My experience, and probably I would rate number one, is when a company makes strategic management decisions based on beliefs, not based on facts. By facts, I mean financial facts of the market, financial facts of the company, financial facts of the prospects and of the economic opportunity, and decisions are made on beliefs. The second thing that I think is common is a rapid expansion that a company may not be properly capitalized, support, or may not have the right management team in place to fully exploit, or was not well thought out. Those are the two most common things that I found in terms of mistakes.
What would you say the worst thing a borrower can do to dim their chances for a loan?
You got to be upfront with the banker. I call it as, let's be candid on the good, the bad, and the ugly. Many borrowers mistakenly paint a very nice picture when you first meet, hoping that they're going to sell you the company and then they let the problems start dribbling out, but hoping that you're already so far into it. And that's a mistake. We've had a lot more success when right up front, the company would tell us what their challenges were, and we're smart enough to figure out the opportunities that the company has. But be upfront with your banker. Let him know the challenges you're facing, as opposed to trying to paint the rosy picture. And then when the banker starts peeling the onion, the banker is disappointed that the rosy picture you sold him or her isn't quite the reality.
Is that onion peeling before you do the loan or after you've done the loan?
During the loan process, when you're examining the package, when you're spreading the numbers, understanding the company, there are things that you can't hide. And then these sorts of things start surfacing as surprises. And had the borrower been completely upfront with the banker from the get-go, it would save everybody a lot of time, and quite frankly, the borrower's credibility would go up. In my particular experience, when I started out a meeting and the potential borrower started out with the challenges that they were facing, quite frankly, I had more respect for them because it told me that they understood their finances, that they understood what the challenges were. And the easy part, they don't have to sell me on that. We've got great cash flow. We've got great collateral, blah, blah, blah. You don't need to sell me on that. Tell me up front what the challenges are and what you're doing to mitigate that risk, and how I, as a banker, can feel comfortable that you're on top of those challenges.
Now, what is the best way for a business owner to make a good impression on a banker?
They say always that the first impression is the most important impression. And I would say that having quality, up-to-date financial statements makes a very good impression. I know that I'm going to get quality financial statements from their auditor, from their CPA, but I want to look at their internal or interim statements and the quality and the timeliness, because that's going to tell me a lot about how that person runs their business. Historically, I have found that if a business owner runs a tight finance department, generally they run a tight company. The best first impression I always had was when the first set of financial statements that I was reviewing were quality financial statements, well done, well prepared, and timely.
Yeah. Yeah, and I've seen so many business owners who I would say neglect or they put up with substandard finance department. And when cash is flowing and business is great, all right, you can kind of cover up and get away with not knowing, your P&L and your balance sheet all that well. But sooner or later, stuff hits the fan, and that's when good financial statements and a good tight finance department is critical, especially if you got bank financing or any investor financing behind you. So,
well, I always liken it, Robert, if the quality of the financial information isn't right, to me it's the equivalent of a football coach who's coaching a team and he doesn't know what the score of the game is. Yeah.
Or it's like going to school and them not giving report cards. You don't know how you're doing, so you can't correct course. What are the top few criteria, Ramiro, that lenders evaluate in approving a loan?
Well, I may have been an exception to the rule, but the first thing I looked at wasn't the numbers. The first thing I looked at was the quality of the management team. I wanted to understand that management team. Did I have confidence in the CEO? Did I have confidence in the CFO? Who are the main components, depending on the industry? Is it the sales manager? Is it chief of operations? I wanted to have confidence that the management team really was up to snuff. Then the next thing that a banker would look at is cash flow. Cash flow is king. Do they have the capacity to repay the loan? Many people make the mistake that they feel that because they've got a strong collateral package that the loan is easy to do. Bankers rely on collateral as for the most extreme circumstances. We get paid by cash flow, not collateral. So once I'm convinced that the company has a strong management team, then the current cash flow, the cash flow that's recurring, that I know I can depend on to get paid, becomes critical. And then I look at the capital position of the company. A well-capitalized company tells me a lot of things about the management team and about the ownership of the company. It tells me that they're not bleeding the company. It tells me that they're thinking about tomorrow. It tells me that they're well-positioned if there's a downturn. Those are the three things that I look at particularly hard.
Ramiro, so with regard to cash flow, so a company will need financing either to buy equipment or might need a line of credit because it has a spike in capital needs and it'll pay it back, shortly thereafter. But is there a debt to equity ratio or some general rule? Because a lot of business owners hope that they can finance growth and, so they want more financing but may not have the cash flow to service the larger debt. Is there some general rule that a business owner can keep in the back of their mind as to how much debt versus equity they should be having?
Well, there are general rules, but I always like to keep in mind that the business owner needs to think in along the following terms. The bank is not an equity partner in the company. Our role is to lend money for them to pay it back with interest, and the entrepreneurial risk is something that there are other non-bank lenders that are willing to take that risk, but banks don't make enough in terms of interest to take on the entrepreneurial risk.
What's the surefire way to irritate your lender?
Well, I would say, Robert, that rule number 1, number 2, number 3 is no surprises. Bankers hate surprises. And for example, I am consulting with a company now. The company lost their CFO, and I know that the bank had a lot of confidence in their CFO. I told the business owner, as soon as that person told me about it, I said, call up your banker today and let him know that your CFO resigned. Well, why should I? That's not the business of the bank. Yes, it is. They're relying on your CFO. They've got a relationship with your CFO. You don't want them to be surprised. Any bad news, deliver it yourself. You all of a sudden receivable, a major receivable went bad. You're taking a hit because you just lost a customer that you had a disproportionate concentration of your revenue. The banker is going to find out anyway. Be guilty of over communicating with your banker as opposed to under communicating, and the banker will appreciate that. The most irritant thing for a banker is a surprise. And let me give you a little inside baseball on why that hurts so much. While the business owner meets and knows the banker has an internal team in the bank that they need to convince that this company is worth banking. And that's your credit administrator or loan committee or however a particular bank handles that. And these are people that are hired there to analyze the company, analyze the financials, etc. Bankers make certain representations to the credit administrators, to the loan committee, about how they view a company. And that includes not just the management team, but their capacity to execute contracts, their capacity to sell, their capacity to contain expenses, blah, 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 blah. And if a banker gets hit by surprises, I can tell you that it's not a whole lot of fun for the banker to go back to the credit administrators and tell them, I made a mistake, this went wrong. And for a banker to repeatedly go back, the banker loses their credibility, and it makes it that much more difficult for that banker to get deals approved going forward. So yeah, I would encourage all of your listeners to err on the side of over communicating with the bank, not under communicating.
Okay, so on that, I think that many borrowers and their officers, including their CFOs, not knowing what goes on the other side of the curtain, are afraid that if they deliver surprises or bad news, that the loan may get frozen, the loan may get called, and the banker may freak out and say, got to get our money back now. And I guess that's a distinct possibility. But what you're saying is, be honest, face the music. Every business has thunderbolts that happen. And just be honest, because the banker well, I want to hear from you. What happens when you get a genuine phone call up front? Hey, listen, something happened today. I just want to make you aware. And it's not good. Let's say they lost a major vendor or a major customer. And they're going to lose money the next year. It's bad. They may not go out of business, but it could impact their cash flow. What do you do on your side?
Well, the first thing I mentioned earlier in the interview was I kept harping on communicating with your banker on a regular basis. So let's begin with that. If a client who's been communicating with me on a regular basis and over X amount of years or whatever, I have confidence in the client and so forth, it's a lot easier to receive that news than from somebody that you see once a year. I've had those calls any number of times. Of course, the question that you ask immediately as a banker is, stuff happens, right? So what are you planning to mitigate the risk that this is going to pose to your company, or how do you propose to make up the cash flow? Do you have a game plan? Are you going to reduce expenses somewhere? I want to get inside the head of not just the owner, but the CFO, and talk real actual numbers. And if my experience was that, 9 times out of 10, when you get a call like that, you sit down with the owner and the CFO, and with a good set of financial statements, and you play the what if scenarios given the bad news using real actual financial statements. A downturn of revenue of 20%, what's that going to do? Your capital position to absorb this, what's your plan to mitigate this going forward? 9 times out of 10 it's solvable. It's when you wait 6 months and you don't let the banker know till it's time to do a review of the loan, and then all of a sudden the banker sees a big surprise that now you're 3 or 4 months into that bad situation. That's when things get nasty.
Yeah. So
I keep harping back. If your listener takes one thing out of this exchange, it's the word communicate. Not just the good things, but the bad things. And like I've said repeatedly, be guilty of over communicating with your banker, not under communicating with your banker.
Right. And, you know, in your current role as a consultant, if, for example, a company got in trouble and their cash flow was going to be diminished, and it put the ability to pay the loan back or clean up the line of credit once a year or whatever, you might then say, and I'd like you to answer this question of what remedial action might the bank take to secure its position? You might require additional equity be raised and injected into the company. You said you want to see their plan with their financials, good financials, and say, okay, we're going to cut X, Y, and Z, and that's going to get us to break even until we recover or whatever. But what action might, with the good communication and upfront disclosure, what then will you do to help the business owner to work with the business owner so that they don't fear getting the loan pulled?
Yeah, I would always encourage a joint meeting, and at that joint meeting, basically, it's let's make a deal. I'm willing to modify the loan, period of interest only, maybe. In exchange for that, I would anticipate that you would, reduce expenses to this much with real financial statements in place that we can look at, or raise capital. It becomes let's make a deal, because the last thing, I'll give you a clue, the last thing that the bank wants to do is call the loan and perfect the collateral. 99 times out of 100, the bank gets hurt when they do that. So the banker would much rather, and assuming that communication has been going on all along and they've got confidence in the borrower, the banker would much rather play let's make a deal. And like I said, I've not been bashful about modifying loans for a particular time, provided that in exchange for that, the borrower commits to certain things that are needed to do, and it may be increased collateral for a period of time. It may be lowering a borrowing base. It could be a number of things. But if you've got the confidence in the management team, the confidence in the owner who's been communicating with you on a regular basis, you can sit down and play let's make a deal, where at the end of the day, what you're looking for is a win-win for both of you. But hiding the problem from the bank it's silly. It's stupid.
So this raises an issue I faced, years ago, where most loan agreements say that the borrower has to disclose material adverse events. And that becomes a judgment call, or what you're saying basically, if you're communicating on an ongoing basis, then the banker knows the good, bad, and ugly, and so if you lose a major vendor or a major customer, that ongoing communication makes all the difference in the world. But I think a lot of business owners, including their CFOs and such, worry, and so they wrestle with what is a material adverse event? Is this a disclosable event? And you're basically saying don't wrestle with it, just just say it. Just disclose it.
Keep the communication going. And let's go back to the example that I used earlier, right? We've got a good company that the bank has a lot of confidence in the CFO. The CFO resigned. Is that something that technically would cause a default or a material adverse condition? Probably not. But just disclosing to the banker, hey, so-and-so, just want you to know that so-and-so just turned in their resignation. They got a very good opportunity, and I'm doing a search now for a new CFO, but I just wanted you to be aware of it.
Okay.
It can be something as simple as that. A lot of folks don't know this, but if you dig through the guts of your loan agreement, you will find in most cases a thing called an insecurity clause. And the insecurity clause basically gives the bank the right to call the loan at any time they feel insecure.
Yeah.
And, beauty's in the eye of the beholder, right? So again, I go back to over communicating with your banker so that when there are challenges, and every business in the world, including the banks themselves, face challenges, that you give them the confidence that you're on top of it, you've got the resources to deal with it, and you've got a game plan lined out. And I always liked it when I was told, here is the game plan, and let's touch bases next month, and I'll give you an update on how it's going.
I mean, there's fraud, and that's criminal, but is there real liability to the officers when they don't disclose?
That would be a pretty severe, I'm not a lawyer. I've seen that situation before, but these were circumstances of out and out fraud, and defrauding a federally chartered financial institution is a criminal offense.
Yeah.
So, something like misrepresenting a financial statement, something along those lines. But those are pretty extreme situations.
Okay. Okay, great. So let's, how does the lender evaluate a loan, size the loan, determine the type of loan, the payment terms, interest rate, covenants?
I always try to start with the basic concept, the concept of a working capital line of credit is to finance the ongoing needs of the company, that in most companies it would be a seasonality type of a thing. That is, there's a season that you're buying inventory and there's a season that you're selling that inventory. And when the money comes in, you'll clean up or partially clean up the line. And then the other general rule is that the term loan you would use for longer term circumstances. Conversely, in real estate, you've got the construction loan. That would be what you would use, what you might call the short-term loan. Mm-hmm. And then you've got what you call, there are various terms for it, the mini-perm or the stabilization period, where it's normally a 3 to 5 year loan for the property or shopping center or whatever it is to stabilize. And then your expectation is that the owner will flip it to the permanent market. Actually, it works better for the owner because the rates are very, very attractive.
So basically, if you have a short-term need, a line of credit is appropriate. If you have a longer-term need, whether it's equipment or a real estate loan, then matching the term of the loan to the term of the asset or the need is basic, the rule of thumb. I was going to say, if somebody has a line of credit and they borrow on that line of credit for needs that are not because they have they need to build up inventory that they're going to sell, and as soon as they sell, they're going to repay the line. Sometimes people use line of credit for whatever their need is, and it may be for a long-term asset, and then they can't clean it up and pay it down during the year. At which point, then I've seen lenders term out. They convert that to a term loan. Is that so? What would you? Is there any caution to business owners as to financing a long-term, growth or long-term asset like equipment with a line of credit?
Well, that's the worst thing you can do, what you just described. And by the way, it's a common thing that unfortunately happens because there's a day of reckoning that's coming.
Tell me something. What do you do as a banker when you get a lousy loan package? I've heard some lenders say, the package comes in, I look at it, it's garbage, I put it at the bottom I just drop it on the floor, it goes to the bottom of the pile. But, it's not easy for companies without a CFO or, to have a complete and really buttoned up loan package. So what, as a lender, do you do when you get something that immediately conveys, like you said earlier, that this company doesn't have a tight financial department?
When you get a loan package that the financial information is not timely or it's ill prepared or you see mistakes, that borrower loses credibility immediately because it speaks volumes about other things. I've always felt that if you don't have if you're a company and you don't have your financial house in order, it's difficult for me to think that your operations are in order, that you've got a cohesive sales team, that you're paying attention to the details. You lose credibility with a banker.
Good accounting will put more on the bottom line than good sales. Because if you have a net margin of 1 or 2 or 5%, and you grow sales $1 million, you're not making that much extra on the million. But if you get a good accounting department to bump your net to 10%, you're going to make a lot more money. So I like to really encourage people to invest in their accounting because the payback is so many times larger than the investment.
Robert, I can't begin to tell you how much I agree with you, or the number of meetings that I've had with business owners who keep talking to me about their top line, and our top line next year is going to be so much, and I'm looking at their margins, and I'm telling them, look, if you can squeeze out 6 more basis points, let's do the math. What does that do to your earnings versus growing the top line at the rate that you want to grow? And how much does it cost you to expand the margin by 6 basis points versus how much does it cost you to hire the 5 salesmen that you're going to bring in to expand that top line? I couldn't agree with you more.
Yeah. So the accountants create the margin, the net margin, by controlling costs and delivering good information, and that's key, is a higher net margin, because growing sales with a low net margin is spinning your wheels.
The synergy, and think about this, the synergy, if you have a strong finance department that the rest of the company respects, imagine the synergy when the CFO meets with the head of engineering and says, look, if you can reduce the widget cost by X, and X doesn't need to be an impossible number, look what it's going to do to the bottom line. Many times there isn't that type of communications between the accounting department and operations, and that's another thing that I encourage companies to do, to make sure that both of those departments are intertwined.
Okay, one last question. A lot of entrepreneurs especially early stage ones, want to get financing based on projections. And bankers lend on historical and I think they get comfort from projections, but they don't base their loan size on that. And so let's talk about the percent that a banker relies on historical financial statements versus the forecast of the future. Is it a 90-10, historical versus 10% projections, or what can you tell an entrepreneur about trying to get a loan based on their forecast?
Well, historical demonstrated recurring revenue is the heart and soul of the credit, because remember what I told you earlier, we're not equity investors in a company.
Yeah.
What we're doing is lending them money, and we want to get repaid. And what's the most consistent source of information that we can rely on is historical financials. I would say that probably if you were to take the commercial bankers, it would be 90-10 reliance on historical financials. If you were to look at the outside investor or equity investor, the ratio would look very, very different, and it might even be disproportionately based on projections.
Yeah. Great. So we're going to wrap up. I think that we've disclosed a great deal of content and some really valuable information on how things look from the other side of the curtain. Is there any last words that you want to offer before we wrap up?
I want to just repeat, err on the side of over communicating with your banker, not under communicating.
Okay.
That's the
all right. Well, thank you so much, Ramiro. It's been a pleasure, and you've been a fountain of information and really valuable information for any business owner. And I will be sure to tell your wife that you are an icon in Miami. So have a great day, and thanks again for your time. I hope you all enjoyed this. This is Robert Band, your business finance expert. Remember, one tip could be worth millions. Have a good day. Speak to you next time. Bye-bye.
Thanks, Robert.
Okay.